Welcome to our series on real estate investing. Today, we're kicking things off by talking about two key strategies: cash flow and appreciation. Whether you're just starting out or looking to expand your portfolio, understanding these concepts can shape your entire investment approach. First, let's talk about cash flow. Cash flow refers to the money you make every month after paying your property expenses, like mortgage, maintenance, and taxes. It's all about steady, immediate income, typically from rental properties. Next is appreciation. Appreciation is the increase in property value over time. Investors who focus on this strategy are playing the long game, buying properties they expect to sell at a much higher value in the future. So, which one is right for you? Over this series, we'll dive into each strategy to help you make an informed decision. In the next video, we'll take a closer look at cash flow properties and why they're popular among certain investors. Stay tuned. In this video, we're exploring cash flow properties. These are properties that generate rental income month after month, providing a steady stream of cash. Cash flow properties can be single-family homes, multi-family buildings, or even commercial spaces. The idea is simple. You collect more in rent than you spend on property costs. But location is key. High-rent areas with strong demand can boost your cash flow significantly. Think about cities with growing populations or near college campuses. Investors love cash flow because of its predictability. You get paid each month, which can be especially appealing if you're looking for short-term returns. But like any investment, there are risks. Things like property management, repairs, and market fluctuations can impact your income. In this video, we'll dive into appreciation. If you're in it for the long haul, this strategy might be for you. Appreciation refers to the increase in property value over time. Unlike cash flow, appreciation doesn't give you immediate returns. Instead, you're banking on the property's value growing over several years. Investors target areas where growth is likely. Places with booming economies, infrastructure development, or limited supply of housing. Think about tech hubs or coastal cities where demand is high. As the area grows, so does the value of your property. The key to success here? Patience. You'll need to hold on to your investment for years to see the payoff. But be aware, appreciation is tied to market cycles. If the market takes a downer, your property's value could stagnate or even decline. Now that we know what cash flow is, let's look at how it varies across different markets. Urban, suburban, talk about what makes a market boom. For appreciation to work, you need to be in an area that's growing fast, whether it's economic growth, job opportunities, or infrastructure development. Some key indicators of a booming market include population growth, new job sectors, and major projects like new transit lines or tech campuses. These signs often point to future property value increases. Examples of these booming markets include places like Austin, Texas, or Nashville, Tennessee, cities that have seen major appreciation in recent years due to economic expansion. Every investment has its pros and cons. So, let's take a closer look at the ups and downs of cash flow investments. The benefits of cash flow who want immediate results. But it's not all smooth sailing. Property management can be a headache, with maintenance and tenant issues eating into your profits. Plus, cash flow properties typically offer less long-term growth compared to appreciation-focused. The long game, meaning market downturns can impact your investment. You'll also need to hold on to properties for years, so it's not for investors who need immediate returns. Why choose between cash flow and appreciation when you can have both? Some properties and markets offer a combination of both strategies. Hybrid investments give you the best of both worlds. Rental income in the short term and property appreciation over time. It's all about finding the right balance for your goals. Areas with steady rental demand and growing infrastructure can offer both cash flow and appreciation, giving you a balanced investment portfolio. Let's bring this all to life with some real-world examples. First, let's look at a successful cash flow investor. Investor A bought properties in mid-sized cities with high rental demand. They focused on collecting monthly rent and have built a portfolio that provides steady income. Now, let's look at Investor B, who bought in an up-and-coming tech hub. Over time, their property value skyrocketed, and they cashed in after several years of holding. Now that we've covered cash flow and appreciation, how do you decide which strategy is right for you? Ask yourself these questions. Do you need immediate income, or are you willing to wait for long-term gains? What's your risk tolerance? How long can you hold on to an investment? For some, a balanced portfolio of both cash flow and appreciation properties might be the answer. There's no one-size-fits-all, but by understanding these strategies, you can align your investments. The next video. Managing a cash flow property can be just as important as buying the right property. Poor management can eat into your profits, while great management can help you maximize your cash flow. So, how do you decide between self-management and hiring a property manager? Self-managing your property allows you to keep all of your rental income, but it's time-consuming. You'll need to handle tenant relations, collect rent, deal with maintenance issues, and stay on top of legal regulations. On the flip side, a property management company will take care of all these tasks for a fee, usually between 8 to 12% of your monthly rent. While paying a property manager reduces your overall income, it can save you time and hassle, especially if you own multiple properties or live far from your investment. If you're focused on scaling your portfolio, outsourcing management can free you up to focus on acquiring new properties. Ultimately, it's about finding the right balance for your investment style and long-term goals. To grow your cash flow portfolio, financing is key. But what financing options are best for cash flow properties? In this video, we'll break down some of the most popular choices and how they impact your monthly income. First up, traditional mortgages. These are the most common for investors, with down payments ranging from 20 to 25%. The higher the down payment, the less you owe each month, resulting in more cash flow. However, you'll need to ensure the rent covers the mortgage and still leaves room for profit. For those who want to put down less money up front, FHA loans are a great option for owner-occupied multifamily properties, with down payments as low as 3.5%. You'll need to live in one of the units, but this allows you to start investing with less cash. Portfolio loans are ideal for investors with multiple properties, as these loans are tailored to your investment portfolio rather than individual properties. Private financing or hard money loans are another option for those looking to move quickly or finance properties that need renovation. Taxes can be a real burden for real estate investors, But with the right strategies, you can significantly reduce your tax liability and boost your cash flow. One of the best tools at your disposal is depreciation. Even though your property might appreciate in value, the IRS allows you to deduct the depreciation of your building as if it were losing value. This can provide substantial tax savings, increasing your net cash flow. Other deductions include property management fees, repairs, maintenance, insurance, and even travel expenses if you need to visit your property. It's important to track all of these expenses throughout the year. Another tax benefit is the 1031 exchange. This allows you to defer capital gains taxes when you sell a property, as long as you reinvest the proceeds into a similar or higher value property. This keeps more money in your pocket, giving you the ability to grow your portfolio faster. Always consult with a tax professional to ensure you're taking full advantage of these benefits. Once you have a couple of cash flow properties under your belt, the next step is to scale your portfolio. The more properties you own, the more rental income you can generate, but scaling requires a solid strategy. To scale successfully, you'll need to maintain a balance between acquiring new properties and managing existing ones. This means ensuring each property is generating positive cash flow before adding another one. Many investors use a strategy called the BRRRR method: buy, rehab, rent, refinance, and repeat. This allows you to pull cash out of one property and use it to fund the next. You'll also need a strong team in place: property managers, contractors, and a real estate agent to help you scale efficiently. As you grow, consider diversifying across different markets to reduce risk and maximize your cash flow potential.